Welcome to PIMCO Pod. In this episode, we discuss how the U.S. trade deficit is linked to its fiscal deficit and how lessons from history suggest it could be difficult to correct trade imbalances without fiscal reform as well. Stay tuned after the conclusion of the podcast for additional important information. The U.S. Current Account, Trade and Fiscal Deficits are closely linked by Tiffany Wilding. Rebalancing trade and reducing the U.S. trade deficit has been a central focus of the Trump administration. Presidential executive orders on tariffs and trade policy have consistently conveyed the view that persistent U.S. trade deficits reflect unfair trade practices of other countries, in contrast to the U.S., which operates as a relatively open market economy. While there is compelling evidence that industrial policies have led to large surpluses in some countries, such as China, this isn't the entire story. Ongoing fiscal deficits in the U.S. have contributed to elevated U.S. consumption of foreign goods, contributing to the trade deficit. Given this economic reality, the outlooks for the U.S. federal fiscal deficit and the trade deficit go hand in hand. U.S. political polarization has challenged even bipartisan plans to implement fiscal reforms that would put U.S. fiscal deficits and debt on a more sustainable course. Congress is negotiating a tax and spending bill that could keep federal fiscal deficits around 6.5% to 7% of GDP for the foreseeable future. Without fiscal consolidation, policies focused on eliminating the trade deficit risk higher interest rates and lower domestic investment, outcomes counter to the Trump administration's goals. As a result, the U.S. trade deficit, like the fiscal deficit, is likely here to stay. Trade deficits, theory and practice. Globalization has accelerated over the past half-century, bringing explosive growth in global trade alongside persistent imbalances. Trade balances are not just about trade. They reflect aggregate savings and investment trends among countries and the fiscal, industrial, and regulatory policies that influence them. Countries with the highest trade surpluses tend to have economies with large manufacturing sectors and high savings rates, while deficit countries show the opposite. Persistent U.S. trade deficits, which worsened after the pandemic, have been mirrored by surpluses in China, Germany, Japan, and other countries. The U.S. trade deficit reflects the economy's propensity to consume more goods than it produces, driven in part by increased competition from low-cost Chinese goods, but also by persistent fiscal deficits. In essence, a set of simple transactions aggregate to a massive scale. U.S. consumers buy less expensive foreign goods, and then the U.S. dollars acquired by foreign businesses in these transactions are invested back into the U.S. The U.S. government bond market and U.S. capital markets in general, both public and private, have been major beneficiaries of foreign excess savings. Global demand for U.S. dollars and for U.S. treasuries as a perceived safe store of account has strengthened the value of the U.S. currency over the long run, as has the more recent outperformance in U.S. assets. Following the pandemic, greater U.S. labor mobility, a culture of innovation, and a lighter regulatory touch, especially in frontier technology fields, have also contributed to the U.S.'s generally better productivity and growth performance. Based on this logic, if the U.S. tries to reduce its trade deficit without also cutting fiscal deficits, the domestic private sector must make up for the lower foreign savings. This is the basic current account arithmetic. The current account includes both the trade balance and income balance and equals the country's domestic investment rate less its savings rate. To do this, the U.S.'s post-pandemic standout economic performance would likely need to diminish, as either U.S. business investment rates or household consumption rates, or both, slow. Whether this process is smooth or disorderly likely depends on markets and how much and at what pace financial conditions tighten. For example, higher interest rates and higher risk premiums across assets. This is the theory, but we can also draw practical lessons from history. Analyzing 32 industrial economies' current account adjustments since the 1970s confirms the theoretical risks are practical challenges as well. Specifically, 5 stylized facts, that is, broad empirical observations drawn from hard data, and a few lessons emerge from past experiences. The stylized facts: 1. Real GDP growth rates historically have tended to fall after a current account adjustment. More specifically, the 3.5% average growth rate in the 3 years leading up to a current account adjustment declined by 1.5 percentage points, PPTS, to a 2% average rate in the subsequent 3 years. Excluding a handful of cases, growth rate declines occurred across nearly all the 32 samples. 2. The larger the current account deficit, the larger the growth drag during and after the adjustment. Specifically, a 4% of GDP current account deficit was associated with a 1.0 percentage point to 1.5 percentage point growth decline. 3. Lower real GDP growth rates were primarily due to a decline in investment to GDP rates. Savings rates declined as well, initially, but investment fell by more. The fiscal deficit usually deteriorated a little bit, implying private savings rates did go up. 4. Current account adjustments by and large coincided with currency depreciation. The average depreciation across the samples was 15%, coinciding with 4 percentage points of GDP current account adjustment. The currency appears to play an important role in buffering the growth drag. Indeed, evidence suggests that the greater the currency declines, the less that growth declines. 5. Most current account adjustments aren't disorderly. Rather, inflation and policy rate peaks have tended to coincide with current account troughs. Short-term interest rates tend to rise ahead of a current account trough because the economy more generally is operating above capacity, and inflation is high and rising. Higher interest rates eventually contribute to economic cooling, resulting in lower inflation, lower rates, and currency depreciation, coinciding with current account adjustment. Now to the lessons. Although most current account adjustments weren't disorderly, there were a handful that were. These adjustments were associated with large currency depreciations and foreign portfolio investment outflows that led to high and rising inflation and necessitated tighter monetary policy after the adjustment. This more restrictive policy stance then resulted in a more prolonged period of flat equity performance and sluggish economic growth. In our sample, these disorderly adjustments occurred around 15% of the time. There were also a handful of episodes that seemingly miraculously realized higher average growth rates after the current account adjustment. These adjustments, we could call them successful beggar-thy-neighbor episodes, were characterized by low growth or even recession before the adjustment, followed by large currency devaluations and a growth acceleration after the adjustment. Another commonality of these success episodes was fiscal consolidation, which contributed to falling inflation and lower interest rates, which, combined with the currency adjustment, contributed to growth acceleration and significantly better equity market performance. These adjustments represented 13% of our sample. Finally, it's also worth noting that meaningful tariff increases did not coincide with any of the current account adjustments in our sample. In that respect, we are in largely uncharted territory in the U.S. this year. Bottom line, what can we learn from all of this? Policy-driven adjustments to a country's current account face significant economic, political, and legal constraints. Both theory and practice suggest that successful adjustments that lead to higher post-adjustment growth rates need to encompass fiscal consolidation, lower interest rates, and significant currency depreciation. Without fiscal consolidation, a period of higher interest rates that leads to lower growth and investment rates is the most likely path. Otherwise, a significant currency depreciation without fiscal adjustment would likely be inflationary and coincide with higher interest rates and significantly higher costs to the economy. For the U.S., with meaningful fiscal consolidation unlikely, any current account adjustment would likely be painful, both economically and politically. The Trump administration has shown a much greater tolerance for market and economic volatility than most observers expected. However, given these realities and the outlook for a stagflationary economic adjustment to the tariff increases, we may be seeing the limits of political will for further bold change. Thank you for listening. That was the U.S. current account. Trade and fiscal deficits are closely linked. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.